Hey guys, it is Julie here with JT Wealth. In today's video, we are taking a look at 3 tech stocks that you probably haven't heard of, but that analysts think look like a great buy. So let's get into it. All right, guys, welcome back and thank you so much for being here. Like I said, today we are taking a look at 3 tech stocks flying under the radar that analysts say buy. So in today's video, we are going to take a look at each of these 3 companies, what they do, and what analysts are predicting for their stock's future. And just before we get into all of that, this is just your friendly reminder that if you enjoy today's video, make sure you hit that thumbs up button and leave your thoughts in the comments down below. Also, don't forget to check out some of the links we have in our description. This includes my Patreon group, which will get you access to our Discord chat. As well, Webull is giving away 4 free stocks right now for signing up and funding a new investment account. So make sure to check them out. All right, now let's get right into these 3 companies. And the first one that we're going to be taking a closer look at today is SharpSpring Incorporated. They trade under the ticker SHSP and are currently at $17 per share. SharpSpring is a rapidly growing, highly rated global provider of affordable marketing automation delivered via a cloud-based service as a software platform. Thousands of businesses around the world rely on SharpSpring to generate leads, improve conversions to sales, and drive higher returns on marketing investments. Known for its innovation, open architecture, and free customer support, SharpSpring offers flexible monthly contracts at a fraction of the price of competitors. They boast a best-in-class sales-as-a-service metrics with significant estimated customer lifetime value and are approaching EBITDA and cash break-even while growing rapidly. And not only are they growing rapidly, but the market for business-to-business marketing automation systems is as well. You can see in 2010, the market was about $225 million. Fast forward 10 years and it's over $7 billion, and it's expected to more than double in just the next 5 years. SharpSpring says that marketing automation is an essential technology that's here to stay, and they are at the beginning of the curve. Businesses are adopting marketing technology today the same way that they began adopting CRM or customer relation models in the 1990s. The value of this platform to online marketers is clear from SharpSpring's latest Q3 results. Specifically, revenue grew 28% year over year to reach $7.3 million, which was a company record. While SharpSpring operates with a net loss, which is not unlike many other small cap tech peers, the Q3 loss was only half of that a year ago quarter. Looking forward, SharpSpring has revised its full year 2020 revenue estimates upwards to the 28 to 29.4 million range, and this would represent a 28 to 30% net increase year over year. The company attributes the projected gains to strong recurrent revenue figures. It was also recently announced that SharpSpring won 3 new Trust Radius awards. They have been named first place for Best Usability, Best Feature Set Award, and Best Customer Support on Trust Radius, their B2B software technology review platform. Now, this marks the 4th year in a row that SharpSpring has been honored as a top choice for customers through Trust Radius, which is known to be an unbiased outlet. Covering the SharpSpring stock for Needham is 5-star analyst Scott Berg. He noted that we believe SharpSpring offers small and microcap investors compelling exposure to the $16 billion plus marketing automation space at an attractive valuation of 5.8 times our full year of 2021 revenue estimate, which incorporates multiple growth vectors not incorporated in the consensus forecast. Armed with fresh growth capital, we believe that SharpSpring's modern solution with a lower TCO is competitively positioned to take share among larger and better-known vendors. With that being said, Berg rates the stock a buy, and with a $25 price target, that implies nearly a 50% potential upside from today's current price. And there are 3 other analysts with ratings on the SharpSpring stock. The stock comes in as a strong buy, with 3 buy ratings and 1 holds. The average price target is $19.50 for just shy of a 15% potential upside over the next 12 months. Looking at the analysts who have covered SharpSpring stock, we have some fairly high-rated analysts here, with the most recent being that Needham analyst Scott Berg with his $25 price target, and the lowest being the hold rating from Roth Capital, which sits pretty much at its current stock price. Next up, we have the Porch Group. They trade under the ticker PRCH and are currently at $13.30 per share. Now, Porch Group has been around for more than 7 years, but only entered the public markets this past December, and the move to public trading was conducted through a merger with a SPAC company, PropTech Acquisitions. So their new ticker, the PRCH, just began trading on December 24th. Through that reverse merger, the company gained $322 million in new capital. Now, Porch.com originally started as a website to connect homeowners with high-quality, reliable home improvement contractors, but has now evolved, and Porch Group now offers services that include software and services tailored to the home inspection and warranty segments, the moving segment, and professional contractors, in addition to home maintenance and home improvement support for homeowners. Porch's services is to the home improvement sector as OpenTable is to restaurants or MindBody is to the fitness industry. As I mentioned, they serve several home service industries from inspectors, moving companies, utilities, warranty, and real estate, with some pretty big name companies in there like Budget. Their platform offers these companies dashboards, online booking and scheduling, calendar and dispatch, and even payment processing. Now, nearly 2/3 of U.S. homebuyers flow through Porch's software platform, and 26% of all U.S. home inspections are managed through their inspection software. Porch believes that they have the potential to grow their revenues by almost 20 times. This is between the mover marketing with $20 million in potential revenue there, insurance expansion for another $400 million, and $400 million potential revenue opportunity in new vertical expansion, assuming over 4 sales as a servant acquisitions per year. Among the bulls for the Porch stock is benchmark analyst Daniel Kurnos, who has a rating of 4.5 stars on TipRanks. He says that after several changes in historical company strategy, we believe the current iteration is well positioned to capitalize on the rapidly growing home services software market. Getting into specifics, he adds, the economic backdrop looks primed for home service and sale-related companies next summer. The user base is relatively sticky. Software offerings include the #1 inspector and moving service platforms, while a personalized move assistant and insurance offerings keep consumers in the system. As primarily a software company attached to the home services space, the valuation looks relatively inexpensive. So he rates the Porch stock a buy, and his $24 price target would mean an 80% potential upside for their stock over this next year. Now, as the Porch stock is fairly new to the publicly traded market here, there is only one other analyst that currently has covered the stock. But he agrees and also comes in with a buy rating. The average price target comes in at $20.50 per share for about a 54% potential upside. And that second rating comes from Michael Grondal from Northland Securities, who has a 5-star analyst rating, and his buy target is $17 per share. And the third company that we are taking a look at today is PubMatic. They trade under the ticker PUBM and are currently at $26.50 per share. Now, this is another company that just launched on the public markets last month. PubMatic shares began trading on December 9th through a traditional IPO. Now, the company priced the initial offering at $20 per share, but the interest was strong and the stock opened at more than $25. Now, PubMatic is another marketing and advertising software company, and its niche is developing software and strategies for online advertisers and digital publishers. The company's platform works for publishers, media buyers, and app developers, and boasts over 1 trillion daily advertiser bids and 134 billion daily ad impressions across its customer and user base. Their core beliefs are that all advertising will become digital and all digital advertising will become programmatic. Ad-supported open internet will thrive, omni-channel platforms will win versus point solutions, and long-term success requires differentiated infrastructure. There is significant tailwinds driving massive growth in digital ad spend, with well over 10% compound annual growth rate across all of the sectors. PubMatic already has a pretty notable roster of clients with some pretty big names in there, from ABC, Microsoft, DraftKings, Forbes, Verizon. It's a really robust client list that they've already built. They are driving down their unit cost with their ad impressions growing over 98%, but their cost of revenue per million ad impressions decreasing by 40%. For their financial summary, we can see that in Q2 of 2020, they did see a bit of a dip to be expected with the pandemic, but now in Q3 of 2020, we are seeing a 33% year-over-year revenue growth, 35% year-over-year growth for adjusted EBITDA, and 16% year-over-year growth for their net income. Describing the market opportunity is 5-star RBC analyst Shweta Kajuria, and she told clients that PubMatic addresses a large and attractive segment of the advertising market with powerful secular tailwinds, including programmatic, CTV, digital video, and supply path optimization. We believe PubMatic can sustain healthy top-line growth of about 20% with robust margins. She added that we estimate PubMatic's global total addressable market, which includes digital plus TV, to be about $260 billion by 2021. Assuming that all global TV ad spends shift to connected TV eventually, PubMatic's more immediate total addressable market, or global revenue opportunity, from the $260 billion global ad spend translate to about $29 billion. She rates the stock a buy with a $34 price target, which would represent about a 30% potential upside over the next year. And there are 5 other analysts with current ratings on PubMatic's stock. It comes in as a strong buy with 5 buy ratings and 1 hold. The average price target is $34.80 for a potential upside of just shy of 32% over the next 12 months. And the good news is that those ratings come from 5-star analysts and are all pretty concisive around that $32 to $34 price point. So there we have 3 tech stocks flying under the radar that analysts are looking quite favorably at. Now you guys know I always love hearing from you, so make sure to leave your thoughts down below in the comments. Have you heard of these 3 companies before, and what do you think of the stock and their potential? Keep in mind that these videos are never a suggestion to buy or sell any specific stock and are just meant to bring new companies to your radar for you to then do your own research and due diligence on before making any investment decision. If you made it all the way to the end of today's video, make sure you give us a thumbs up and that you're subscribed to the channel as well. Thank you guys so much for watching. I hope you have a wonderful day, and cheers.